Now, if I may say a couple of things here, the basis for this kind of, if you want, prospects, the positive prospects that we have, is some related, it is related mostly with the buoyant financial markets and the cyclical recovery that we are expecting in the manufacturing and in trade underway, both in the developed but also in the emerging markets world. And this brings the second bullet that we have here, that it discusses the important issue that the global prospects that we have, growth prospects also, they are driven by emerging markets. Now, this one, of course, it is contrasting with a slowdown that we're going to be seeing and some kind of rebalancing in China that it is expected at the moment. Now, the prospects that I just outlined, they are facing, of course, a number of challenges, as we put it here as headwinds. Now, the challenges to the global growth prospects, and I am not going to be going into detail, it has to do with weak productivity, infrastructure backlog, the weak trade that we see in specific areas and with special also orientation in terms of regions. Then is the demographics that we have heard it, and because the demographics is becoming an increasing part of what is going to be the challenges, we have put here a chart with the working age population growth that we see in the different parts of the world, and you see that we have the advanced, we have the emerging, and we have split also China and the low-income developing countries. And you see that the prospects for 2016 to 2021, the yellow bars over there, that for the advanced markets, they are expected to be slowing down, to be probably negative. And the same thing for China, while we see the emerging markets and also the low-income developing countries, that the percent of the working age population, it is going to be increasing relative to the whole population. So for the advanced markets is especially a constraint that we should be acknowledging. The other challenges, they have to do with the policy uncertainty, and I'm going to be speaking a little bit more about it, and also something that we have heard and we hear very often in the financial press, but also from a number of international investors, and this it has to do with the debt overhang in the world. And this is problematic, especially as we move into the new era that we see in terms of interest rates, global interest rates, exchange rate movements. It is going to be a big challenge for the low-income developing countries. So please move to the right side of this slide, and you are going to be seeing the gross to GDP for both the advanced economies and also the emerging markets. It is very important to note that for the advanced countries, the growth for the total debt, the blue line, it has been on an upward move since 2006-07, when we had the global financial crisis started, and then it moved all the way to the end of the crisis, and after that it has been stabilized. And the two components that you see over there is both the non-financial and the public debt, with especially the issue of the public debt, the sovereign debt for the advanced economies to be a major issue that we realize it at the moment. And it has not been only in the case of Europe, but it has been the case also of Japan and also the Western Hemisphere, namely the United States in particular. So you see from moving from about 50% of GDP, 55% of GDP, to in 2007, 2008, all the way to about 85–90%. So it's a significant increase, and this is something that it is a major concern also for policymakers, but also for investors, and how this development that we have seen, how it is going to be resolved coming in the next years, especially in the current world environment. Now, the chart under it, for the emerging markets, you see a similar kind of a situation, and almost the same kind of a pattern after the crisis. But we see a little bit of a different kind of a picture, and a picture that also is very important, I think, that we should be stressing. It has to do with the non-financial trade, and this is in particular the line that you see, the green line, that it shows the top 25 percentile change in the non-financial debt, that it is on an upward move, and this it has to do in particular with the developments in the developed world, the growth in the developed world, that it has not helped them in order to be also developing sufficiently enough in order to be able to reducing debt. So this accumulation, it is going to be a big kind of a challenge for the low-income developing countries, but in general also for the emerging markets in general. Now, we talked about the growth aspects and what are the challenges. Now let's go into the second area that most economists, they are looking at these days, and this it has to do with the inflation. Now we put here as end of deflation, and this is a question mark. This is very much related to the following slides that I'm going to be talking about. The important thing to note is that the low inflation period that we had seen in the past 3-4 years, it has been in the US, the structural change in a kind of an increase that it has been more pronounced since the second half of 2016, and you can see it from both the 10-year US break-even and also the 5-year. It is on a consistent upward trend, which means to us that the deflation period that we had seen, especially in the United States, that it is coming to an end. But you can see it also on the right-hand chart that the CPI inflation rate for other countries, both for the advanced countries but also for some emerging markets, it is showing some kind of a similar kind of a trend, that deflation that we have seen in most parts of the world, probably it is coming to an end. We're going to be seeing, because this is of course is going to be affected by current events, but at the moment, or at the time that we were doing this kind of work, it seemed that this was the prevalent trend, probably a deflationary period. And we are going to be seeing Poland in the emerging markets, but Mexico that it is stabilizing or going down, and this it has to do with the developments in the United States for Mexico. Now, let's translate the prospects that we said about growth and about inflation to what is happening, or what is we are expecting for the financial world, and we are specifically, we're going to be mentioning the interest rates, the trajectories from now on, and what is going to mean also for exchange rates. Now, based on what we said so far, the prospects for increased growth and end of deflation, it seems that the low interest rate environment that we had seen in the past 3 to 5 years, depending on the region that we're looking, it seems that it's coming to an end. And this is something that we try also to put some kind of quantification there based on these charts. And the first chart on the left, it shows the US yield forecasts. And these forecasts, they are coming before the election, the US elections, and after the US elections. And this is for the 10-year Treasury yield we see the period October 31st, 2016, that the median, I think this is the most representative kind of a measure that we should be looking, it was close to about 2.1%. Now, the forecast after the elections, and that it was at the end of the year, it has moved by about 0.5% to about 2.6% as the 10-year Treasury yield forecast. So this is a clear indication that the interest rates, or the low interest rate environment, probably it is coming to an end, especially if we are looking at the US, that it leads also other interest rates worldwide. And the same kind of a picture, it is reinforced by the chart that we have at the right of this slide with the euro-dollar futures. You can see that the red line, which is the most recent one, that it is above the previous period's lines, the curves. Now, let me go quickly also and bring the picture worldwide of what it means from the interest rates and the interest rate environment that we are looking. Now, this picture that I mentioned about the US, it seems that it is more prevalent for the other advanced countries, and in these ones you can see, and we say spreading across the advanced economies, you can see it also that this is almost the picture, probably not as pronounced for all countries, especially for Japan, but it's for Germany and the UK that we have in this chart. So the normalization of whatever we call normalization, when we are moving out from the low interest rate environment, it is more spreading into the advanced markets. Now, let's come on this chart in order to be stressing what are the effects of whatever we felt before with the interest rates and now where we are going. And this chart, it is showing how we view the interest rate environment, how it has affected the flows to the different areas of the world, the financial flows. And we try to have a picture of what we feel that it was the major components in terms of the financial flows into the advanced economies in this chart. And the important thing to see is that the 2009, that we say that it's pretty much the end of the global financial crisis. And after that, the policy environment that we had, the interest rate policy environment, that it was contributing to the low interest rates, both in the United States but also in Europe. We do not forget that Draghi said whatever it takes, which means that interest rates, they are going to be playing a role in taking the European economy out of any stress. These are the reinforcing forces of the low interest rate environment. And you can see from the 2009 till end of 2016, beginning of 2017 that we had seen, the blue line, which it represents the advanced economy bonds, that they were on an upward trend, and very pronounced one. In terms of billions of dollars, we went from about 50 billion to about 1.5 trillion in terms of increases. Very clear sign that during the low interest rate environment, international investors, they were moving into bonds of advanced markets. Now, let's go to the next slides and try to analyze, based on where we are today, what is the expectation, the prospects in terms of these interest rate movements. And the 3 points that we have here, they are pointing that the movement outside from the low interest rate environment is going to be, first of all, slow. And the changes that we are going to be seeing, they are not going to be as pronounced as probably some of the people that they are talking about the normalization of interest rates, that it is going to come. And we are going to be showing a few slides here that they are going to be supporting this kind of a view. Now, one of the issues is that still we see some countries that they can issue with negative rates. The small changes that we are seeing, that they are coming from different areas of the world in terms of adjustment. And I'm not going to be also spending a lot of time in this area, but I would like to point out that the changes that we see here in the left graph, it shows how the spread between the 10-year and the 1-year yield in the US, how it was in the period of 2010 to 2013, about 220 basis points. In the period of 2016, end of August of 2016, it had moved down by about 125 basis points. So it took quite a bit of time, about 3 years, in order to be seeing some kind of a change in terms of these spreads, the spreads between the 10-year and the 1-year. So it means that this is going to be a slow process. Now, another kind of a point that I would like to bring in, this kind of normalization of the interest rates will, of course, depend very much on the exit strategies that we have from quantitative easing in the different countries. This is not going to be easy. The prospects that we have and the debates whether and how the shrinking of the central bank balance sheets, it is going to be moving. It's a big also issue right now for both policies in Europe, but also in Japan, and we know also what is happening here in the United States. And this kind of a chart on the right, that the source is the Citibank, it shows how big are the portfolios, the balance sheets at the moment, in terms of the central banks holding sovereign bonds, and how difficult it's going to be going into a normalized period, reducing, in other words, the extent of the balance sheets of the central banks. Now, since George is showing me that I don't have enough time in order to be talking about all of the charts, let me also give you a glimpse of what are the next slides here. The emerging markets, which I said that it's a very important component about the global growth. The positive aspect that we see is that the commodity prices, they are off the troughs that we have seen, but still we see relatively high volatility. And this kind of a chart, it shows the major commodity prices, but more pronounced, you can see what is happening in oil, the significant drop, and the relative, at the moment, stabilization at the levels that we are at the moment. No predictions of where we are going to be going, but from financial press, it seems that we are going to be $10, below $10 above the current rates of the Brent, which is between, let's say, 45 and 60, if you would like, a range that it's a working assumption for some of us at the fund. Now, the important thing also is that to note that the capital flows to emerging markets, you can see it from the lower chart. It has started going up a little bit in the period of the last year or so. Even though we have seen that the rates that they are issuing, it is getting a little bit higher. So the emerging markets, even though at the prospects of higher interest rates, they are able to access the markets, they have market access, but the borrowing costs, they are going to be higher. And this may be spelling problems down the road in terms of restructures or distressed debt as we are moving into the next phase of the global developments. Now, these two charts, they are showing the estimated probability distribution of US forecasts, and this is based on some kind of analytics that we have done. It is the left side, it has to do with the GDP 2017 fourth quarter, and you can see that after the elections, the importance is that the estimated probability of the GDP, it is moving from around 2% to about 2.5%, and also inflation, it is moving at a little bit of a higher rate. So both from the analytical point of view, from probability distributions that we have done in terms of GDP and inflation, both of these analytics, they show that the current developments, they show some kind of an increase in both growth and inflation for the US. Now, the same things here is in terms of the translation of growth and also inflation in terms of interest rates, but the important thing is that the interest rate movements that we expect outside from this kind of an outlook for the US, it seems, and this is the US Treasury bill, the Treasury bonds, the 10-year, we are going to be, or we are expecting more pronounced interest rate movements as we move forward in the next 1 to 2 years. Now, this is an important graph, I think, that it translates all of these kind of developments in what we see in terms of the expected inflation. The expected inflation in the US, it is expected to increase, as we said, but the nominal interest rates, it is going to be much higher in terms of percentage, in terms of percent increase, and therefore the difference between the nominal and the nominal yield and also the expected inflation, it shows us that we are going to be seeing a real interest rate that is going to be increasing. It has increased and it is expected to increase in the foreseeable future. Now, how does this translate into exchange rates? Of course, for all of us that we have been working with exchange rates, we do not know, and we do not risk it at the moment in order to be making any assumption or any kind of a projection. But what we have put here is the trade-weighted dollar performance of the Reagan years and also the Trump years. And this is something that I would like to show you, at least from the inauguration rate, what we had seen during the Reagan period, and the sharp appreciation, and also I'm leaving a question mark of what is going to be happening in the red line, which represents the Trump presidency. Now, recent developments that we see in anticipation of the advanced economies interest rate movements and the US dollar appreciation, we have seen so far that the emerging market flows, they have been affected. The chart at the left, it shows China, and it shows the FDI capital flows. You can see it especially more pronounced in the most recent period, the second half of 2016. The flows, they have been decreasing. Now, the portfolio debt flows that you can see it also at the right slide, also we have seen that they have been decreasing. So the expectations of higher interest rates, it seems that they have been affecting the trade flow, the non-FDI financial flows, and also the portfolio flows in emerging markets. Now, the issues that we try to analyze also is how this kind of an environment is going to be affecting the borrowing costs. This one, you can see that we have put some kind of a stylistic way, the impact of the higher interest rates on the interest rates of the economies, and you can see that some of the economies in terms of the increases of the interest rates and the impact on the local interest rates, they are going to be more pronounced in countries like Turkey, Russia, and so forth, and less pronounced in countries like Thailand, South Africa, and the rest. This one, I'm not going, it shows the sentiment indicators, and it represents the policy uncertainty. We see that the sentiment indicator for both Citi and the Morgan Stanley, they are showing a decline. So the uncertainty, it is there of what is going to be happening both in the US but also in the world. 2 seconds in terms of the current prospects. The important thing is based on what we have seen at the moment and how we feel that the current prospects are evolving, especially with emphasis into institutional international investors' decisions. First of all, we see, or we have trying to analyze, and we try also to make sense of what is happening in terms of development. More convergence in central banks' monetary stances is expected in terms of quantitative easing, and this convergence is coming after we had the comments from the ECB officials that probably they are going to be also following to some extent of what's going to be happening in the US. The second thing is the US Treasury yields. They expect to continue trending a little bit down, especially after the March 17 FOMC trajectories that we have seen, the less steep growth that we have seen. If you have questions on that, we can discuss after at the session of the questions and answers. Now, the important thing also to say here is that the major market participants, they are cautious at the moment. This is what we hear. They are waiting of what are the economic and the political outcomes in the US, especially the fiscal stimulus, as we hear, the taxes, and also what is happening in Europe, especially with the elections and the Brexit that we heard also from George, and also the global markets of how they are going to be evolving. At the moment, we feel that based on the situations that we see, that they are not going to be extremely abrupt, they are going to be relatively calm, and the implication for that, for both the equity and the fixed income markets, it seems that they are going to be trading at rather low levels. So let me stop here. I exceeded my time. And I would welcome any kind of questions that we're going to be having later on. Thank you.
Thank you, Michael. And our next speaker is Marcos Popriowski-Riviero. He's an economist in the World Economic Studies Division of the IMF. And previously he worked in the fiscal affairs of IMF and African departments. He is doing a lot of work in international economics and finance and microeconomics, and we will have the benefit of having his comments on issues related to financial stability.
Thank you so much. Good morning, everybody. Thank you so much for the invitation. It's really a pleasure to be here in this conference. And so, as George just mentioned, I've been doing a lot of different things in the IMF. Right now, I'm actually the team drafting the World Economic Outlook. So, if you have any questions about the projections and the outlook, I think Michael did already a very good job in giving a bit of the flavor of the outlook, but I'm glad to answer in the end more questions if you have about the projections. For this conference, we thought about doing something a bit more analytical, more close to the question that was posed by the conference, which is the globalization, is it real? And I think there is no more topical question than that nowadays. So we actually thought about bringing the analysis that we presented in our last October Real World Economic Outlook Chapter 2 report, where we try to understand what was the cause and what are the drivers behind the global trade slowdowns. There is a lot of complementarity also to the presentations that we saw in the previous section. So, of course, this doesn't affect, that's not the only angle of globalization. For me, globalization also means flow of labor, free flow of capital, financial integration, but of course, free flow of goods and services is a huge and important part of globalization, and I think it's important to understand exactly what are the drivers behind it. Okay, so the motivation for the talk and for our chapter is basically given by this chart. We've seen a similar version in some previous presentations, but basically this chart shows on the red bars what has been GDP growth since the 60s, and the blue bars what has been import growth for the world since the 60s until 2011 here. Okay? And what we see is actually the blue bars were always much higher than the red bars. So trade was growing in a much faster pace than GDP was growing in the last 4 decades or 40 years, right? So this is basically the average GDP growth, around 3% in these 4 decades, while trade, import growth, and that's how we measure trade here, was growing around 6% on average across these 4 decades, right? So the motivation of the chapter and the motivation, I think, of the discussion nowadays about the deglobalization is given by this next chart, where we see that for the period between 2012 and 2016, we just updated this with the just released projections and estimations from the World Economic Outlook last Tuesday, we see that import growth is growing at a much lower pace than it used to grow, around 3%, and much closer to what GDP growth or GDP is growing. Okay? So a big slowdown in terms of trade, which could imply some deglobalization, some reduction in global trade going forward. So what we do in this chapter and in this presentation, we try to understand how widespread is this slowdown. Is this connected to a particular region, to countries, to certain products? What are the drivers? Okay, so how much in particular is this a symptom of a weak recovery since the global financial crisis, or a change in the composition of economic activity? And what are the role of other factors that have been discussing so much in the press, such as protectionism and the production fragmentation across countries, which is called the global value chains. Okay, and finally, we discuss a bit of the policy implications in the way we see at the IMF of these results. So, going to the question of widespread. So, these two panels, they basically show that the slowdown in real trade is quite widespread across countries and across products. So if you look at the chart on your left, we actually took the average real import growth, I'm talking about volumes here, between the period 2012 and 2015, and compare to the period before 2003, 2007, before the global financial crisis. The only countries that saw real import growth faster in the more recent period are those in blue, painted in blue in this chart. So as you can see, all others, they have negative import growth on average, okay, compared to the period just before the global financial crisis. I think that really proves how widespread is this slowdown. The other chart on the right basically shows, in terms of products, how widespread this slowdown is. So we actually took for several different sectors, okay, the average real import growth for the period 2003-2007 and 2012-2015, and what we see is that the entire distribution, okay, if you see the panel in the bottom, the entire distribution across all products has shifted to the left to growth rates that are much closer to zero or negative than what we had in the period 2003-2007. I think this pointer, we cannot really see it. We also look in terms of goods and service. And here, as expected, the red line shows on your left chart the real import growth in terms of service, and the blue in terms of goods. And goods actually have like a larger slowdown than the service trades, showing a bit more resilience of like trading service, but still quite also observing a slowdown also in trade service. Okay. Across different products, and that's already like telling for our main results, we see that for the difference between 2003 and 2007 and 2012, 2015 on average, you see that capital goods were actually had like a much bigger decline. So the first item here, the red bar, which represents 2012, 2015, and saw a much sharper decrease in terms of growth rates than the blue bar in the previous periods, while other products that are more related to final consumption, so non-durable consumption, saw a lower difference between these two periods. So what this chart tells us already, without going to the econometric analysis, is that actually capital goods, which are normally more connected to investments, the demanded component of investment, actually have suffer a larger slowdown. So probably large part of the global trade slowdown is connected to the reduction in the investment, the investment component of demand, of aggregate demand. Okay? So now we go a bit more analytical and serious about what are these drivers, and we made like a research analysis in our chapter where we try to answer again those two questions. What's the role of activity and its composition, economic activity and composition, on explaining this global trade slowdown, and what are the roles of other factors, in particular trade protectionism and the global value chains. Okay? So for that we do actually a three-pronged strategy. We first estimate import-demand equations, macroeconomic import-demand equations, okay, associating import growth to demand and relative price. And then this is of course is a partial equilibrium analysis, so we also do a general equilibrium analysis, which is this balloon in the middle, the multi-country, multi-sector general equilibrium model. And finally, we go to a very disaggregated level of the data, sectoral level, and try to see what are the role of other factors when you look at like a different other factors when you look at different sectors. So, going to the macro estimations of import growth, what we show here is in the black line the actual series of a global trade. Okay, for our full sample of 150 countries. Since 1985 to 2015. And the other lines, they are basically what are the predictions of our estimated model. And what we see is actually our macro estimated model do a pretty good job in explaining global trade across the sample, the time sample. But in the more recent periods of 2012-2015, we see a much our model over-predicting trades. Okay, this shows, and this is basically the difference. These bars basically for the full sample, advanced economies and emerging economies. It shows the difference between that actual trade and the predicted trade, and we are always making mistakes on the negative side, meaning that actual data has been always lower than what we expected with our model. Okay, but this is relatively small if you compare to how much we are able to explain. Okay? Just to give a sense, okay, we are able to explain by estimating the cause of import growth in terms of like aggregate demand and relative price, but mainly aggregate demand. We are able to explain 90% of the slowdown in global trade for advanced economies and 8% of the global trade slowdown for emerging market economies. So around 3/4 to 80% for the full sample of the global trade slowdown can be explained by a slowdown in economic activity. Now, we are not saying that this is a cyclical effect only. This also has a structural part which is related to the shifts in the demand composition across the globe. Okay? So, but still, if you compose this structural and cyclical component of aggregate demand, it explains around 3/4 of the global trade slowdown. Okay? So, in order to understand if this is true, so this was a partial equilibrium analysis again, in order to double check if in a general equilibrium model where you have like relative prices endogenously correcting, we apply a general equilibrium model, and this general equilibrium model also is able to explain the role of other factors such as protectionism, such as trade costs. So I'm not going to go in details to the model. I invite you to read the chapter. We have like an extensive analytical appendix explaining the model. It's based on this Eaton, Corton, Neiman, and Romali's paper from the American Economic Review, just published last year. But basically here in this general equilibrium model, we have 4 factors that could explain global trade. Okay, demand composition, changes on productivity, change on trade balance, and change on trade costs, where trade costs is basically a catch-all term for protectionism, global value chains, any other thing that's not explained by demand composition or productivity change, basically. And what we see when we estimate that model, we see that like demand composition, which is the red bar in these charts for advanced and emerging economies, explain again a large component of the global trade slowdown. So for advanced economies, around 66%, 70% of the global trade slowdown can be explained by the shift in the demand composition under this general equilibrium analysis, and trade costs a much smaller fraction. For emerging economies, 50%, around half of the slowdown can be explained by shifts in the demand composition, and the rest can be explained by trade costs. So again, I'm going to go very quick because for the sake of time, but basically both models, partial and general, they basically give the same message. Demand composition, shifts in demand composition, and a reduction in aggregate demand are very, very important to explain global trade, even though there is a part of global trade that's not explained by that. And that's the last part of our analysis, where we try to understand what are these other factors that may be explaining the slowdown in global trade. Okay? So I'm going to show some very quickly stylized facts, and then we go to quickly to the econometric analysis. And here the idea is to show that protectionism may be on the rise, and at least free trade agreements and reduction tariffs have been slowed down. So this chart in particular shows how tariffs have declined over time, but more recently it basically flattened for advanced economies, and it is still a bit on decline for emerging and developing economies, but it's still almost flattened, right? At the same time, we saw this picture before in this conference. The free trade agreements, the number of free trade agreements being signed is on the decline, okay, and that you see in your left-hand side chart. And the coverage of these free trade agreements, even though it's still increasing, it's reaching a plateau, it's reaching a peak more recent, okay? Another thing that we analyze in the chapter is these non-tariff barriers or temporary trade barriers, which was discussed by Bill here, how difficult it is to measure them. Well, we try to come up with a measure basically on this global trade alerts database and Cherry Bound database, and what we see is actually there was, of course, during the more recent periods, discriminatory measures, okay, increasing these temporary trade barriers, but also some liberalized measures, which are the green bars. On the net effect, which is the black diamonds, we see that actually on the net effect has been an increase in these temporary trade barriers, an increase on this protectionism, if you like, a measure of protectionism. Finally, the other factor is this global value chain participation, and we also discussed this in this conference before. We go to the data, we go to this IORA multi-region input-output database, and we collect data for 150 countries, and we come up with the standard measures of global value chains in the literature. And what we see in those lines, by these different measures, is a flattening in the increase in the evolution of global value chains participation over time. So, if anything, global value chains are flattening. They are not growing as fast as they used to, and this may cause an effect to global trade. So we go to the data and we ask an econometric model with 6-digit sectors, a very disaggregated database, and we see, let's see how much of the unexplained component, which was 1/4 of that global trade that I was not able to explain with my macro model of aggregate demands, how much I can explain by these other factors of protectionism and global value chains. And it turns out that the yellow and the gray part shows that almost half of this unexplained component, of this 1/4 of global trade slowdown that I'm not able to explain, is explained by these two factors. Protectionism, the no reduction in tariffs, the increase in non-tariff barriers, and the reduction in free trade agreements, and the flattening or the reduction in the growth of global value chains formations around the world. Okay? So, what are the policy implications here? Like just 2 minutes. We believe from our results that slow global trade will likely persist in the medium term, okay? As long as global activity remains weak, and as long as investment, so this demand composition change, remains weak. We see like China now rebalancing from an investment model to a more consumption model, and that definitely may have an impact on global trade going forward. And even if the activity, economic activity gathers momentum, as we'll be seeing a little bit in this last semester, the second semester of 2016, we don't expect trade to return to the growth rates that we saw before the crisis in the 2000s of around like 8%, 9%, because they were usually characterized by a large investment growth in emerging markets, particularly China, okay, and the formation, very fast formation of global value chains during that period, okay? So what are, just to finalize, what are the policy implications of these results? It's like countries, economies should adopt policies to boost economic growth, especially investment, and we see that investment is indeed recovering, particularly in some advanced economies. We can discuss this more during the questions. And this could be helpful for boost trade growth, okay? But the role of trade policy, as I showed, has an effect and shouldn't be underestimated, okay? So protectionist measures, especially more recently, have contributed to the slowdown, also in emerging market economies, okay? So reviving trade liberalization process and reducing man-made trade costs, these non-tariff barriers, would be very useful to boost global trade going forward, okay? Regarding global value chains, we don't have a clear answer. Why? We are not able to understand if like, the flattening, the formation of global value chains is a natural process of industrial organizations around the world, or if it's related to some man-made policies, trade policies, okay? To the extent that it's related to trade policy should be reverted to boost growth. Finally, just to conclude, there has been a big discussion, I think this is an important discussion of this conference. Trade policies has winners and losers, okay? And we have, when designing trade policies, we also have to take into account the losers of like trade policies, and we have to make sure that like adjustment costs are mitigated for those populations or for those communities that are heavily affected by global trade. I stop here. Thank you so much.
Thank you, Marcos, and thank you, Michael. We can take only a couple of questions. Can you, Marcos, can you stay here? Michael, do you have any questions that we can ask?
I will.
Yes, Michael.
Okay, so, right, so thank you for presenting. So I'm Professor Raud, I'm here in the School of Economics. I have a couple of questions. So, so you show some relationship between, say, the election day or the election time and some changes in inflation forecast or expectations. And so my question is mostly about what you think is behind this effect. In some sense, you know, the election period came together with some new data about employment in the US and new good prospects. At the same time, the Fed announcing future increasing rates, which I'm using a term which you might like, being from Greece. We call it Delphic forward guidance. So I was just wondering whether you can comment on that, or whether you think these are revising expectations for inflation are due to maybe like elections or some new prospects for fiscal policy, or is really like more coincidental, or is due to the new prospects for policy done by the Fed over in the next maybe year or so. And the second question, very quick. So you show some data on global debt, which, if I remember, is trending up above 200% for advanced economies. And so my question is whether this data is about really like global debt in the hands of the public, or global debt in a gross term. Because indeed we have more public debt around, but part of it is being acquired by central banks, especially in the US by the Fed with QE, and also in Europe. And on the other hand, also some of this debt is purchased by foreign investors. So once you net out all these effects, I was wondering whether indeed we have about 200% global debt over GDP, or we should revise downward these estimates.
Okay, both questions, we can explain it in different ways, but I am going to be giving you the quick and dirty way. In the interest of time, and if you would like also after the session, we can discuss more. The question that you asked about what made the difference before and after the elections in terms of inflation. Usually, we use also different market participants' views in order to be making this kind of projections. And the markets, they were showing us that because of what it came after the elections, and especially the prospects of the fiscal stimulus and also the changes that they had been, at the time, they were expected to come in terms of the US policy, in terms of the interest rates and so forth. These were the two factors that they came very transparently in the discussions that we had with market participants, and these were the issues that we took into consideration when we constructed the probability distributions that they came out from Monte Carlo simulations in order to be moving forward. So it is expectations based on the pronouncements of the new government. That it was the major factor. In terms of the GDP numbers, you're absolutely correct. The numbers that I showed over there is gross debt that we are having. And these are mostly the numbers that they are coming from the global financial statistics of the IMF. And the most recent ones that we have seen, that I have put over there, it is coming from the different surveys that we are having, also from different entities, including the AMT, including the OECD and the World Bank. And this is what is reflected over there. But the answer, the short answer for you, it is that these are gross numbers.
And we can take one more question, and I'm sure we will have the opportunity to discuss them.
Hi, I actually have a question for the both of you. Thank you for your informed presentations. For Marco, you had a slide in your presentation where you showed the African continent and import growth being very, very strong, or actually outperforming the rest of the globe. I just wanted to know what gave the African countries a comparative advantage to do well in the face of persistent global weakness, and what's the outlook for the future for the African continent? And my second question is for Michael. You spoke about challenges earlier, weak productivity growth, and it's still not clear why we're having the weak productivity growth since 2000 for the advanced developed economies. And the debt overhang. Do you have any prescriptions to solve what countries can do to solve either of those problems. Thank you.
Thank you. Thank you for the question. So regarding Africa, I think part of this more positive, let's say, import growth in certain African countries is basically a carryover effect. These countries have been growing for the last decades relatively strongly. The last decade was one of the best decades for African countries. And they still, a part of the public investment infrastructure projects are probably causing this demand effect for imports of all kinds of goods. Going forward, actually, Africa is not doing as well as it did in the previous decades. And if anything, particularly for commodity exporters, given commodity price, but if anything, we expect a bit slower growth for African economies than we saw in the 2000s, for example. They have been more resilient than in the past for example, for the global financial crisis, but still the growth, given the population growth that these countries and the level of income that these countries have, the growth rates are still positive, but way too small to actually bring their GDP per capita to reasonable levels. So some growth, but not as strong as we expected in the past.
Okay, the two questions, productivity growth. Productivity growth, it has been studied extensively in both the fund and also the bank, the World Bank. Now, there are no clear answers, and we do not know exactly, but we are theorizing. The most prominent analysis that I heard about a week ago, it was coming from the World Bank, and they are saying that probably it is some cyclical factors. And they are not very clear, but this is a study that is going to be coming the next month or so, and we are going to be having a little bit of more analysis if there are some kind of cyclical factors in productivity. Now, the other factor that the fund, it has done some kind of work, it relates to the transmission of technology, if you would like to, into the growth and the production of the economies, especially the advanced markets. And we have seen that the technological innovations and the way that they have been adapted in production, they have not been as pronounced as they used to be before. And in the past 5 to 8 years, 9 years, it has not been as pronounced as it has also been indicated with different indicators at the fund. So we see the cyclical, and also we have the explanation from the technology. It is not sufficient and good answers, but this is something that we have seen. I do not know if you have any.
Yeah, I just would like to add. We actually launched 2 weeks ago. Madame Lagarde actually launched in the American Enterprise Institute a paper from the research department about productivity growth, where actually what Michael said is basically the message. There are huge headwinds in terms of structural factors, aging, demographics, technology, but there is also some scars from the global financial crisis, some cyclical factors that were not addressed, so this slowdown investment is affecting productivity growth going forward. So I really invite you to take a look on this paper. It discusses the causes of this productivity slowdown in detail.
And with this, I would like to conclude the session and ask for only 5 minutes break. You can ask the presenters directly if you have any other questions, but really you need to come back within 5 minutes to conclude the program on time. Thank you.